welcome to the July 2022 monthly market update. My name is Ryan Flanders, and I'm the Chief Investment Officer for the Flanders Group. Much like in Bill Murray's Groundhog's Day, every month feels like we're waking up to the same themes playing out over and over again. And June was another wretched month for financial markets. Coupling growing concerns about a possible recession with continued high inflation has caused investors to continue to panic with new concerns now about future earnings, on top of the already existing worries about interest rates. Stock markets across the globe were down substantially for the month. The horrendous month also capped off a horrible quarter, with stock markets both here and abroad down between 10 and 30%, and with even fixed income down sharply. Much like in April, this month there was nowhere to hide. According to the Wall Street Journal, this was the worst first half to start a year since 1970. All eyes were again on the Federal Reserve. With stubbornly high inflation, the Fed has raised interest rates now 3 times to start the year and has indicated that the hikes will continue until inflation is back under control. At the start of the month, markets responded to these hikes by repricing both bonds and stocks. At the tail end of the month, though, those higher rates continued to increase the risk of a possible recession. With the Fed committed to regaining control of inflation, possibly at the cost of recession, fears about the economy have risen. A struggling economy raises concerns that corporate earnings may be lower than anticipated, which caused the market to spiral even deeper. If it could go wrong for the markets, it pretty much has to start this year. And despite the perfect storm for markets to start the year, though, June showed signs that the wave of damage may have crested. Inflation, while still high, showed signs of easing as supply chains continued to improve, while situations abroad, such as the war in Ukraine and China's ongoing COVID lockdowns, appear to have stabilized. And with worries of a recession increasing, even as inflation begins to moderate, longer-term interest rates have begun to pull back some. So while real risks remain, at least they have started to plateau and have even improved a bit in some areas. Another positive factor looking forward is that despite the risks and the headlines, the economic news is still okay. Companies are still hiring, which helps to prop up spending growth, and business investment still remains healthy. The big question looking forward, though, is, will that continue? We're starting to get some warning signals, particularly with diminishing consumer confidence. And although these are only warning signals and not full alert sirens, it does continue to trend down, and that could prove to be problematic. But here too, the risks appear to be leveling. As we see stabilization with inflation and in turn interest rates, consumers will feel more stable with the economy. On the whole, while growth is slowing, we see little direct fundamental damage in the data yet. In other words, slowing is still growing, and that's the intentions behind the moves the Fed is making to curb inflation. Combining solid economic performance with moderation of the inflation risks and long-term interest rate increases should provide support for financial markets moving forward. Historically speaking, after a pullback like the one we've seen this year, future returns have been positive, and often substantially so. It's been a painful start to the year, but as painful as this is, it continues to set the stage for future growth, and we're now well into that process. Now, that's not to say we're done with the turbulence, but despite the headlines, most of the risks appear to be moderating. And as they moderate over time, the fundamentals will improve. As we've discussed for years, underlying fundamentals are what ultimately drive both the economy and the markets. And that's the bottom line here. Lots of bad things have happened, but the bad news is starting to get less gloomy, and in some cases, even have begun to improve. And as markets start to reflect that, we should see more stability. That's it for this update. Thanks for watching. Join me in August for the next one. If you have any further thoughts or questions, please feel free to reach out.